Good morning, and welcome to our latest equity research briefing. Today, we are initiating coverage on what we consider the hidden automation titan behind the global digital workforce, trading under the ticker symbol TITN. Our initiation rating is an overweight, with a 12-month price target of $145, representing an asymmetric 35% upside from current trading levels. For institutional allocators, TITN represents a rare convergence of hypergrowth and accelerating free cash flow generation. As the global enterprise pivot towards robotic process automation and AI-driven workflow orchestration accelerates, TITN is positioned as the foundational infrastructure layer. In fiscal year 2024, the company posted top-line revenue of $1.45 billion, reflecting a robust 22% year-over-year growth, while simultaneously expanding gross margins to an industry-leading 84%. The market has fundamentally mispriced TITN's transition to a fully cloud-hosted SaaS model, creating a dislocation between intrinsic value and current market pricing. We view this as a prime accumulation zone. Pivoting to market dynamics, the total addressable market for intelligent automation is experiencing secular tailwinds that defy broader macroeconomic cyclicality. Our proprietary channel checks indicate that the TAM is expanding from roughly $20 billion today to an estimated $65 billion by 2028, representing a compound annual growth rate of 26.5%. This is not merely legacy screen scraping. We are observing a paradigm shift toward agentic AI and cognitive automation. Currently, AI-integrated workflow adoption stands at 42% among Fortune 500 enterprises, up from just 18% 24 months ago. Crucially for TITN, this transition creates deeply embedded infrastructural moats. The switching costs are structurally prohibitive once these automated workers are woven into enterprise resource planning and human capital management systems. This stickiness is quantified by TITN's best-in-class dollar-based net retention rate of 115%. As human capital costs rise globally, the return on investment for TITN's deployment shrinks to under 9 months, making it an essential IT expenditure. Examining the top-line trajectory, TITN exhibits a highly resilient revenue profile anchored by its accelerating annual recurring revenue, or ARR. Over the trailing 36 months, the company has delivered a 3-year ARR compound annual growth rate of 28.4%, significantly outpacing legacy software peers. A critical driver of this multiple expansion catalyst is the successful cloud transition. Cloud-delivered revenue mix now constitutes 68% of total bookings, up sharply from just 45% in fiscal year 2022. This structural shift effectively smooths out revenue lumpiness associated with legacy on-premise perpetual licenses and drives superior lifetime value. Furthermore, forward visibility remains exceptional. Remaining performance obligations, or RPO, recently eclipsed the $1.1 billion threshold, providing immense downside protection to our forward revenue estimates. The velocity of net new enterprise customer additions, coupled with structural price increases rolled out in Q1, provides a clear line of sight to our projected $1.8 billion fiscal 2025 revenue target, heavily de-risking the top-line consensus estimates. Moving down the income statement, TITN's margin architecture demonstrates formidable operating leverage. Early-stage growth software companies often burn cash to acquire market share, but Titan has decisively crossed the chasm into sustained profitability. Non-GAAP operating margins have inflected dramatically, printing at 18% in the most recent quarter, a stark contrast to the 4% recorded in fiscal 2022. This margin expansion is driven by economies of scale in cloud hosting and optimized sales and marketing efficiency. Most notably, the free cash flow generation is achieving institutional-grade velocity. We are modeling a 24% free cash flow margin for FY24, translating to approximately $348 million in unlevered free cash flow. When applying the Rule of 40 metric, a vital health indicator for SaaS valuations, combining revenue growth and cash flow margin, TITN scores a highly elite 46. This elite dual-mandate execution of 22% top-line growth coupled with 24% FCF margins severely undermines the bearish thesis of commoditized, low-margin automation. Let us delve into the valuation multiples, where the primary investment thesis solidifies. Despite its top decile operating metrics, TITN trades at a relative discount to its infrastructure software peer group. On a forward 12-month basis, TITN is currently valued at an enterprise value to sales multiple of 6.8 times. This represents a significant compression compared to the peer group average of 8.5 times, suggesting the market is penalizing the stock for historical rather than forward-looking execution. Looking at bottom-line valuation methodologies, the next 12 months enterprise value to EBITDA sits at an attractive 24.5 times. Meanwhile, the adjusted forward price-to-earnings ratio is stabilizing at 38 times. In a normalized interest rate environment, a Rule of 40 software constituent with expanding gross margins typically commands an EV to sales multiple in the low double digits. We believe this multiple compression is transitory. As the market digests the structural sustainability of the FCF yield, we project an aggressive multiple expansion, driving our $145 price target. This cohort data reveals the durability of Titan's growth algorithm. The fundamental efficiency of their go-to-market motion is exceptional. The ratio of lifetime value to customer acquisition cost, or LTV over CAC, has structurally expanded to 5.2 times, up from 3.8 times a year prior. This implies highly accretive capital allocation by the management team in their enterprise sales division. Simultaneously, the customer payback period has compressed to a mere 14 months. This rapid return on sales investment means the company self-funds its hypergrowth without diluting shareholders. Furthermore, the land and expand strategy is firing on all cylinders. The cohort of enterprise customers generating over $100,000 in annual recurring revenue grew by 31% year-over-year. As these mega-cap clients deploy automation across varied silos, from finance to supply chain operations, the expansion velocity accelerates, structurally insulating the top line from macroeconomic shocks and cementing Titan's position as an indispensable vendor. Transitioning to the technical setup and fund flows, the microstructure of TITN's equity suggests heavy institutional accumulation. After an elongated period of base building, the price action recently triggered a decisive upside breakout above the critical 200-day simple moving average at $102.50, on volume that was 150% above the 20-day average. This technically validates the fundamental turnaround narrative. Furthermore, 13F filings indicate robust institutional sponsorship. Institutional ownership has climbed 450 basis points quarter over quarter, now sitting at a commanding 82% of the float. This effectively reduces circulating supply and creates a floor on the equity price. We are seeing active accumulation from major quant and growth at a reasonable price mandates. Concurrently, momentum oscillators indicate the equity has room to run. The Relative Strength Index, or RSI, has cooled to a healthy 58 following a recent bullish consolidation flag. The absence of major overhead resistance on the volume by price chart suggests the path of least resistance toward the $130 level before meaningful technical friction occurs. No rigorous institutional analysis is complete without a comprehensive bear case. In our downside scenario, we model a price target of $85, representing a 21% downside risk. The primary structural threat to TITN is the bundling power of hyperscalers, specifically Microsoft's Power Automate ecosystem. If Microsoft aggressively subsidizes its automation suite to capture enterprise licenses, TITN could face severe pricing pressure, causing gross margins to decay. Secondly, in a hardened macroeconomic contraction, chief information officers may enforce strict IT budget optimization. While automation is deflationary, the upfront integration costs could elongate sales cycles beyond the historical 6 months, immediately impacting quarterly billings and forward guidance. Lastly, there is an execution risk regarding generative AI. If TITN lags in commercializing agentic, unstructured data processing capabilities, legacy RPA modules may face obsolescence, causing the critical net retention rate to slip below the 100% threshold, triggering severe multiple contraction across the valuation matrix. Conversely, our bull case scenario models a price target of $185, unlocking a massive 72% upside trajectory. The primary catalyst here is the hyper-monetization of generative AI. If TITN successfully pivots from rules-based RPA to autonomous agentic AI capable of dynamic decision-making, we project a massive wave of enterprise-wide wall-to-wall deployments. In this scenario, pricing power strengthens, driving operating margins to peak above 25% by fiscal 2026. This would fundamentally alter the EPS trajectory, leading to consecutive quarters of massive earnings beats and triggering aggressive Wall Street estimate revisions. Furthermore, in a consolidating software landscape, a dominant pure-play automation leader with deep enterprise penetration becomes a highly accretive M&A target. Legacy software behemoths struggling with organic growth could view TITN as a premier acquisition asset, justifying a substantial strategic premium. In this bull case, the EV to sales multiple expands rapidly to 12 times, reflecting scarcity value in large-scale AI monetization. In conclusion, TITN represents a highly compelling asymmetric risk-reward opportunity for institutional capital. With a 3-to-1 upside to downside ratio, our overarching recommendation is a high-conviction overweight. For growth and technology-focused mandates, we suggest an optimal portfolio weighting of 250 to 300 basis points. The synthesis of robust top-line CAGR, expanding free cash flow margins, and an attractive valuation discount creates a localized margin of safety rarely found in pure-play infrastructure software. The global workforce is fundamentally restructuring, and TITN provides the essential digital picks and shovels for this multi-decade transition. The near-term catalyst is the upcoming Q3 fiscal 2024 earnings print on November 15th, where we anticipate upward guidance revisions on full-year free cash flow. We advise utilizing any macro-induced weakness to aggressively accumulate shares ahead of this catalyst. Thank you for joining this initiation of coverage briefing. We will now open the floor to questions from our institutional clients.